OG John AG here. The CME is implementing yet another round of margin increases. This marks the second hike in a mere 72 hours. The initial adjustment was announced on January 28th. Now, effective Monday, February 2nd, which is tomorrow, the exchange is raising maintenance margin requirements once more. These new levels build directly upon the figures established just 3 days prior. Gold margins are climbing an additional 33%. Silver is seeing another 36% jump. Platinum is up a further 25%, and palladium is increasing by another 14%. These are sequential compounding increases layered on top of the previous adjustment. The expense of maintaining a single silver contract has surged from approximately $25,000 prior to the first hike to around $66,000 after January 28th. Come Monday, that cost is ascending to an even greater height. This signals desperation, and tomorrow's market opening is poised to be utterly pivotal. However, here is the factor that makes Monday's session even more extraordinary. Throughout this past week, procuring physical silver has grown challenging to the point of being nearly impossible. Bullion Stars founder, Tori Personson, posted a trading update on Saturday, indicating it remains uncertain whether they can source any additional silver inventory whatsoever. Golden State Mint halted silver sales for the entire weekend, unable to secure metal. The last instance of such a scenario was during the initial pandemic panic. The United Kingdom's premier precious metals refiner and retail distributor, Bed & Co., has suspended its online sales operations. The physical silver market is becoming untethered from the paper market, and Monday's opening will reveal whether the paper construct can maintain its grip or if it shatters entirely. One crucial point for newcomers before we proceed: I do not sell trading signals, mentorship programs, memberships, or any products. Should anyone assert otherwise, block them immediately. My role is solely to present the unvarnished landscape. I do not traffic in hype, fear, or greed. I've been inundated with messages from you stating this content assists in viewing both market perspectives, comprehending the underlying data, grasping the true events, and formulating improved decisions. My presence is exclusively on X and YouTube. As many of you are aware, my handle on both platforms is OG John AG. That is the singular method to verify it is genuinely me. I assume no responsibility for any other source. Protect your interests. I will never attempt to sell you anything. Now, I am eager to hear your perspectives. Comment below with OG John AG and your market outlook. What is your prediction for silver's performance in the coming week? What is your instinct signaling for Monday? Let's integrate all the themes we've explored this week with the current developments. On Friday, we witnessed a dramatic metals crash. Silver plummeted 31%, registering its most severe single-day loss on record. I demonstrated how JP Morgan closed 633 silver short contracts precisely at the nadir. Their timing was flawless. They exited their positions. We analyzed Kevin Warsh's potential role as federal chair, his anti-QE stance, his advocacy for rate cuts coupled with balance sheet reduction. Markets sold off aggressively on that policy pivot away from limitless liquidity. Now the CME is hiking margins for the second instance in 72 hours. This follows immediately after extreme volatility and some of the most precipitous price declines we have observed. The official rationale is enhanced risk coverage, but experienced traders interpret the scale and timing as a deliberate maneuver to squeeze out over-leveraged long positions. The expense of maintaining open positions is set to become significantly more costly, potentially triggering additional forced selling or violent price oscillations. Regardless, here is my focus. Shanghai spot silver is currently trading at $122.13. COMEX silver sits at $85.33. The Shanghai premium therefore stands at 36.80. This represents a 43.13% premium. On JD.com, China's predominant e-commerce platform, gold bars are selling for roughly 572 pesos per ounce. Physical silver bars are listed at 163.35 per ounce. That constitutes a 91% premium relative to US COMEX prices. Allow me to reiterate that. JD.com silver at $163, COMEX at $85, a 91% premium. The divergence between paper silver and fundamental silver value is at its most extreme point now. Based on pure supply and demand fundamentals, silver should be trading around $130. On every prior occasion where we have witnessed a 30% discount from fundamental value, silver has subsequently rebounded. The silver backwardation must resolve. It is unsustainable for physical metal to trade at a 91% premium while paper contracts crash. One of these two markets is profoundly mistaken, and the physical market is screaming that it is the paper market that is wrong. Bullion Star reports difficulty nearing impossibility in sourcing physical silver. Golden State Mint shutdown due to inability to secure silver. Bar & Co. in the UK has shut down online sales. To quote Bullion Star directly, throughout this period of market revaluation, dealers have witnessed extreme and unprecedented physical demand. At the same time, replenishment options have become increasingly scarce with physical metals drying up and mints operating under enormous backlogs. In such an environment of constrained supply and sustained physical demand, sharp price declines in the paper markets are difficult to reconcile with the realities of the physical precious metals market. The summary: physical demand is extreme, supply is constrained, mints are backed up, and yet paper silver crashes 31%. This is the stark disconnect we have been monitoring all week, and Monday's opening will test whether this paradox can persist or if it finally ruptures. Now let's examine Bitcoin. In my last video, I advised watching to see if Bitcoin closed the weekend above $82,000 or fell below. A close above $82,000 would be bullish for Monday. It closed at $78,000. This is my personal assessment, but the posture appears weak. Bitcoin is at $78,000 as we speak. If Monday's opening fails to demonstrate strength, Bitcoin could decline to $74,000 or lower. Should Bitcoin breach $74,000, Michael Saylor's MicroStrategy position would go underwater. That represents a psychological threshold capable of triggering amplified selling across cryptocurrency and risk assets generally. Consequently, the Asian market opening tonight holds greater significance than any other factor. Shanghai futures, Hong Kong markets, Tokyo, they open first. If Shanghai silver holds at $122 or ascends while COMEX is closed, that signals physical markets are not panicking despite the margin hikes. If Shanghai gaps down and follows COMEX lower, it indicates the selling pressure is globally synchronized. The Asian Open establishes the tone for the entire Monday session. Reviewing the analytics, approximately 75% of viewers presently watching are not subscribed. If this unfiltered, real-time analysis is cutting through the noise, providing you a clearer edge in understanding the complete narrative from both perspectives, and aiding you in making more informed decisions, please click subscribe. This is how we cultivate a community founded on truth, not sensationalism. If this content delivers value, type OG John AG in the comments. It assists us in discerning what matters most to you and keeps this channel firmly anchored in reality. If this approach is not for you, no offense taken. I do not pursue hollow metrics. I am here for those who seek clarity amidst the polished hype of the mainstream financial narrative. I will not tell you an asset is going to the moon, nor will I tell you it is going to zero. I am here for individuals who desire substantive clarity, not the scripted, superficial commentary ubiquitous elsewhere. We are currently observing two diametrically opposed realities. Paper reality. CME hikes margins twice in 3 days. Silver down 31% on Friday. Warsh tapped as potential Fed chair, perceived as anti-QE and bearish for metals based on policy analysis. Dow futures are down 300 points as the Kevin Warsh sell-off extends. Options traders are now the most bearish on the US dollar in recorded history. Physical reality. Silver has posted 9 consecutive months of gains, its longest winning streak in history. Gold, 7 straight months green, also its longest winning streak. Dealers are shutting down sales because they cannot source metal. Shanghai premium at 43%, JD.com premium at 91%. China's gold imports from Russia have achieved a record high. Physical demand is described as extreme and unprecedented by dealers themselves. One of these two realities will overwhelm the other on Monday. Either the paper margin hikes force further liquidation and the paper market prevails in the short term, or the tangible scarcity of physical metal becomes undeniable and the paper market loses all credibility. Monday's opening will provide the answer. Furthermore, we have the situation with Iran. A direct quote from Iranian officials: "The Americans should know if they start a war, this time it will be a regional war." Former President Trump stated he deployed troops and warships toward Iran. Qatar's foreign minister delivered a final message to Iran's supreme leader. The supreme leader's response was, "We will not start a war, nor do we wish to attack any country, but our people will deliver a powerful blow to anyone who attacks them." Escalating geopolitical tensions in the Middle East could serve as an additional catalyst for precious metals. Should tensions intensify overnight or Monday morning, safe haven capital flows could potentially override the selling pressure induced by margin hikes. Let's now address both potential scenarios for Monday, as this presents a binary outlook. Bearish case. First, CME margin hikes take effect Monday. Traders who endured Friday's crash now must post 33% more capital for gold, 36% more for silver. If they cannot meet these calls, forced liquidation ensues, prompting more selling. Paper prices decline further despite underlying physical scarcity. Friday's price action felt like forced liquidation rather than fundamental selling. Monday could deliver more of the same. Bitcoin at $78,000 appears weak. If it breaches $74,000, triggering the Sailor underwater threshold, cryptocurrency sells off further. Risk-off sentiment proliferates across all asset classes. Asian markets gap down at the open. European markets follow suit. U.S. markets open weak. Dow futures are already down 300 points. The selling cascade intensifies. Warsh policy analysis is interpreted as extremely bearish for metals. A strengthening U.S. dollar renders metals more expensive for international buyers. The primary rationale for holding gold, as a hedge against currency debasement, diminishes if the Fed shrinks its balance sheet and turns off the monetary printing press. Iran tensions could escalate. Any military incident might trigger panic selling before safe haven buying materializes. Phase 1. Liquidation continues. Everything sells as participants scramble for cash. Margin calls ricochet across all asset classes. The $15 trillion in market value erased on Friday could expand to $20 trillion on Monday as contagion spreads. This is the bearish scenario. Paper overwhelms physical in the short term, leading to more pain before any recovery. However, here is the bullish case. JP Morgan covered its shorts on Friday at the absolute bottom. Major banking institutions have exited. Short interest is now reduced, diminishing suppression pressure on any subsequent upward move. Physical holders in China and India refused to sell at $78 to $90 per ounce. They are holding firm. Dealers cannot source metal. Mints are backlogged. This constructs a solid price floor. The physical reality cannot be ignored indefinitely. The CME margin hikes might represent a final desperate maneuver, potentially protecting clearing firms from a major participant in distress. Following this, if physical demand remains unbroken, if Shanghai premiums persist at 43%, if JD.com premiums stay at 91%, the COMEX pricing system forfeits all credibility. Monday could mark the inflection point where physical markets triumph. Silver has 9 straight green months. Gold has 7, the longest winning streaks in their histories. Friday's 31% crash did not terminate the bull market. It was forced liquidation, not fundamental selling. Historically, every instance of a 30% discount from fundamentals has precipitated a powerful bounce. History suggests this is a buying opportunity, not a conclusion. Bitcoin at $78,000. If Asian markets stabilize, if Bitcoin holds and rebounds toward $82,000, $85,000 on Monday morning, that shifts overall sentiment. Risk-on behavior returns. Cryptocurrency stabilizes. The liquidation cascade ceases. Iran tensions could de-escalate through successful diplomacy. The message Qatar delivered might lead to a negotiated deal. Absent military strikes, the geopolitical premium evaporates, allowing markets to rebound. The Financial Conditions Index has declined to 98.3, its lowest level since early 2022, indicating financial conditions are loosening. The Fed has cut rates by 175 basis points since September 2024. The dollar is down 12% over the past 12 months. Investment-grade credit spreads are at their tightest since 1998. Financial conditions have essentially returned to pre-rate hike levels. This is the macro backdrop that supports elevated asset prices once the forced liquidation cycle concludes. Moreover, there is nuance to Warsh's actual position. Markets may be misinterpreting him as a pure hawk. His genuine stance is more complex. He is demonstrably bullish on AI and productivity gains. He believes AI-driven productivity growth will allow the economy to expand rapidly without igniting inflation. This philosophy grants him latitude to support rate cuts even amidst economic strength. He is not as bearish as the knee-jerk market reaction implies. He desires rate cuts. He simply wants balance sheet discipline concurrently. Rate cuts without concurrent QE might impair short-term liquidity, but it does not equate to the termination of the bull market. Therefore, Monday converges on these elements. The Asian opening tonight, Bitcoin's overnight action, Iran-related news, and whether the CME margin hikes trigger another wave of forced selling, or if physical scarcity finally overwhelms paper manipulation. I am monitoring Shanghai futures intently. If Shanghai silver holds at $120 or climbs, that is a bullish signal. If it gaps down severely, that is bearish. Bitcoin must hold $78,000 at a minimum. A break below $74,000 presents a significant problem. The Iran situation must remain confined to diplomacy. Any military escalation on Monday morning alters the entire calculus. Where does this leave us? 3 key takeaways, and then we'll conclude. Number 1. CME margin hike, the second in 3 days. Gold up 33%, silver up 36%, effective Monday. This could compel further liquidation, or it could be the final desperate act before physical markets prevail. Physical dealers are shutting down. Bullion Star cannot source. Golden State Mint cannot secure metal. Bed UK has closed online sales. Shanghai premium at 43%. JD.com premium at 91%. Paper and physical markets are entirely disconnected. Monday's opening decides which reality wins. Number 2. Bitcoin at $78,000 appears weak after I highlighted the importance of a close above $82,000. That is my personal view. But if Monday fails to show strength, a move to $74,000 or below becomes probable. The Asian opening tonight matters more than any other event. Shanghai futures, Hong Kong, and Tokyo open first. They will set the tone. If Shanghai silver holds or rises, it's bullish. If it gaps down, it's bearish. The next 12 hours prior to the U.S. market open on Monday will reveal the probable direction. Number 3. Warsh's policy stance is more nuanced than the initial bearish reaction suggests. He is dovish on rates, bullish on AI-driven productivity, but disciplined on the balance sheet. He is not as extremely bearish on metals as Friday's sell-off implied. Iran tensions possess the potential to escalate or de-escalate rapidly. Silver has 9 straight green months, gold has 7, the longest streaks in their histories. Friday's action was forced liquidation, not a reflection of deteriorating fundamentals. Historical precedent indicates that 30% discounts from fundamental value tend to bounce back, but Monday's opening will either confirm or deny that pattern. The unresolved tension is this: physical scarcity is at extreme levels, with dealers shutting down and premiums ranging from 43% to 91%. Yet paper margins have been hiked twice in 3 days, forcing more selling. Bitcoin is weak at $78,000. Iran tensions are elevated. Monday opens with all these forces converging. Does the physical reality finally overwhelm the paper manipulation? Or does one more wave of forced selling arrive before the violent snapback? This constitutes the most critical market opening we have encountered all year. Asian markets tonight, U.S. markets Monday morning. Every theme we've tracked this week, J.P. Morgan's exit, the Warsh policy discussion, physical scarcity, margin hikes, Iran tensions, it all culminates tomorrow. Stay alert. Monitor the data closely. The next 24 hours will determine whether this was the final flush or if we experience another leg down before physical markets ultimately prevail. Conduct your own due diligence. Comprehend the risks involved. Be accountable for your own decisions. Establish a clear plan and understand your time horizon. Are you trading based on an hourly chart or investing according to a multi-year thesis? Plan and position yourself accordingly. If you are over-leveraged, these margin hikes will force you out irrespective of the long-term outlook. But if you are positioned appropriately and understand the underlying dynamics, whether you are stacking physical metal and waiting for further dips to accumulate more, as many seasoned individuals here with decades of experience are doing, then let's observe what Monday's opening delivers. Time will ultimately reveal the outcome. But if you are new to this environment and lack a concrete plan, these volatile conditions can destroy capital. Invest using logic, not hype. Employ your intellect. Do not follow any individual blindly. OG out.